Wow, this is absolutely crazy. Okay, let's dive right into this because if you've been watching the markets at all lately, you've probably seen the absolute tear that Nebius Group has been on. I mean, we are talking about a stock that is up more than 40% in just the past month alone, and if you zoom out a bit, it is sitting on a nearly 4 times total return over the last year. That's the kind of momentum that makes people either extremely rich or extremely nervous. Welcome to today's Explainer. Today, we're not just reading the hype, we are tearing it apart. Joining me to cut through the noise is our chief investment analyst. So, before we get carried away by these massive green candles on the chart, lay it out for us. What are the real fundamental forces driving this rocket ship right now?
It's great to be here. To understand this price action, we absolutely have to ignore the daily market noise and look strictly at the data. If you examine the recent filings and market events, there are three very clear, very real catalysts driving this surge. First, an absolute blowout first-quarter earnings report showing massive, accelerating revenue growth. Second, the securing of a historic $27 billion five-year infrastructure agreement with Meta. And third, a massive $2 billion direct investment and a highly public vote of confidence from NVIDIA. Now, for everyone who may be new to this company, let's establish their basic role and core objective. Think of it this way. If artificial intelligence models are these massive, extremely power-hungry engines, Nebius is building the specialized high-voltage power grids and the heavy-duty knowledge factories required to actually plug those engines in and keep them running efficiently without burning out. They provide the fundamental physical and cloud infrastructure that makes AI deployment possible at a global scale.
I love that analogy. They are the literal power grid for the AI engines. Okay, so today we have a very strict 4-stage agenda to figure out if this company is actually worth your hard-earned investment dollars. We are going to quickly look at the stock surge itself, dive deep into those Q1 financials, decode their economic moat, examine their partnerships and physical scale, and finally, look at 3 very specific future survival scenarios.
Exactly. We are going to conduct a rigorous, data-driven deep dive. Let's look past the flashy news headlines and evaluate the actual numbers.
All right, let's jump right into Section 1, the Nebius stock surge. So I have to ask on behalf of everyone watching, why is this relatively unknown AI cloud infrastructure company suddenly the belle of the ball? How does a company go from flying somewhat under the radar to a nearly 4 times return in a single year? Is this just another meme stock? And if they're so perfectly positioned, why is the skepticism so heavy? We've got a short float of over 20% here. Professional money managers are actively betting millions that this stock is going to crash. Even Jim Cramer recently came out on broadcast and said, "Let that come down, and then we'll take a look." What is the market seeing that we aren't?
The data shows this is far from a meme stock situation, but that high short interest is a crucial data point we cannot ignore. It tells us that institutional skepticism is indeed very high. The market is currently undergoing a massive foundational shift, moving from a phase where tech giants were merely experimenting with AI to a phase where they are aggressively deploying it in real-world commercial applications. Nebius positioned itself early to capture this exact wave. However, the primary reason for the skepticism isn't necessarily a flaw in Nebius' current product, but rather the intense, long-term capital requirements of their business model. Building these AI factories requires billions of dollars upfront in capital expenditures. The bears are arguing that as massive hyperscalers like Amazon Web Services and Microsoft Azure ramp up their own infrastructure, they could trigger a brutal pricing war. The short sellers are betting that Nebius simply won't be able to maintain its profit margins when the industry giants start throwing their massive weight around. That warning from Cramer simply reflects a broader market fear about the sustainability of these astronomical tech valuations in a highly capital-intensive sector.
So the shorts think Nebius is going to get absolutely crushed by the big boys because it costs way too much to build these power grids. But how do you explain the massive 684% revenue growth staring right at us?
That 684% year-over-year revenue growth in Q1 2026 is exactly how the company counters that exact skepticism. It is proven by the numbers. While the bears are speculating about future price wars, Nebius is currently executing at an astonishing level right now. Their business model, these knowledge factories, is highly optimized for a very specific type of workload that the broader, legacy hyperscalers often struggle to handle efficiently. They aren't just selling generic cloud storage, they are selling highly optimized bare metal GPU performance that AI developers desperately need at this exact moment. The underlying data shows that demand is so heavily outstripping supply that Nebius' sales pipeline actually quadrupled quarter over quarter. They are capturing the market that Amazon and Microsoft simply cannot build out fast enough to serve. That is the fundamental driver behind that aggressive revenue jump.
So what you just said basically means they are selling the exact shovels everyone needs for the AI gold rush, but the short sellers think they'll go broke actually building the shovel factory. That makes sense. Let's move to Section 2, inside the Q1 financials. Wait a minute, doctor. Before we get lost in the spreadsheets, let me ask the ultimate so what question. What does that 684% growth actually have to do with our stock accounts? Does this hypergrowth actually translate to the bottom line for investors, or are they just burning billions of dollars to buy revenue? We're talking about a jump from $50.9 million in Q1 2025 to $399 million in Q1 2026. That is literally a vertical line on the chart.
That is the absolute most important question to ask. Growth without a path to profitability is incredibly dangerous in this macroeconomic environment. If you look at the financial data, the most critical takeaway isn't just the top-line number, it is the composition of that revenue. 98% of that $399 million came directly from their AI cloud segment. That specific segment grew by an astonishing 841%. This tells us two fundamental things based on the filings. First, their strategic pivot to becoming a pure-play AI infrastructure provider is totally complete and functioning. Second, their customer acquisition strategy is working flawlessly. They aren't relying on legacy, slow-growing business units to prop up the numbers. They are firing on all cylinders in the exact market sector that is experiencing the highest global commercial demand.
Okay, so they are selling a ton of AI cloud space. But again, are they actually making money doing it? Because I see so many tech companies triple their revenue and somehow triple their cash burn at the exact same time.
The filings provide a clear answer. Yes, they are exhibiting massive operating leverage. In Q1 of last year, the data shows they posted an adjusted EBITDA loss of $53.7 million. This quarter, they swung to a positive adjusted EBITDA of $129.5 million. Furthermore, their cost of revenues dropped significantly, falling from 49% down to 26%. That mathematically proves they are achieving economies of scale. As they add more clients to their existing infrastructure, the incremental cost of serving each new client drops dramatically. Plus, if you look at their balance sheet, they are sitting on $9.3 billion in cash and just secured another $6.3 billion in capital. They possess the absolute financial firepower required to continue building out these capital-intensive AI factories without immediately needing to dilute shareholders further.
Whoa, hang on a second. I'm looking at their reported net income, and it says they made over $600 million. But there is a massive warning sign staring right at us. A $781 million gain from a ClickHouse revaluation? Why is the market going wild when, if you strip that paper gain away, they might actually still be running a massive deficit on their core bottom line?
That is a very sharp observation, and it highlights exactly why you must always read the footnotes in financial filings. The reported net income is heavily inflated by a one-time, non-cash accounting gain. Nebius owns an equity stake in a data processing company called ClickHouse. ClickHouse recently raised funding at a $15 billion valuation. Because of standard accounting rules, Nebius had to mark up the value of their existing stake on their balance sheet, which resulted in a $781 million paper gain. It is crucial to understand that this is not cash generated from their core AI cloud operations. If you look at their adjusted net loss, which strips out these one-time non-cash items, they actually posted a $100.3 million loss. However, that loss narrowed by 20% year over year, and their operating cash flow was positive $2.3 billion. So while the headline net income is completely distorted by accounting rules, the actual underlying cash generation of the business is genuinely and demonstrably improving.
So what you just said basically means their core business is definitely growing and generating real cash, but that massive headline profit number was mostly just an accounting technicality from a side investment. That makes a lot of sense. Let's move to Section 3, decoding the economic moat. Okay, here is my problem. Amazon, Microsoft, and Google have practically infinite money. What is Nebius's irreplaceable weapon against these massive hyperscalers? Why wouldn't a customer just go to Amazon Web Services? That sounds a little abstract to me. Can you give me a simple analogy of what they are actually doing differently?
Absolutely. To understand their moat, we have to look at where the AI industry is heading right now, not where it was a year ago. Think of building an artificial intelligence like putting a student through medical school. The training phase is like sending them to school for a decade to read every single medical textbook in existence. That requires a massive, one-time burst of effort and raw computing power, which is something Amazon and Microsoft are exceptionally great at. But the inference phase is when that student actually becomes a doctor and starts diagnosing hundreds of patients every single day in the real world. The entire tech industry is currently shifting from the school phase, which is training, to the doctor phase, which is inference. Inference requires constant, highly optimized real-time computing power. It is a completely different workload profile. Nebius is specifically optimizing their entire physical and software infrastructure to dominate this inference phase, where speed, latency, and cost per token are the primary metrics that actually dictate market share.
Okay, so they are building the ultimate doctor's office for AI. But how do they actually do that better than Amazon? What is their specific technical edge?
It is proven by the numbers and their recent strategic acquisitions. They recently acquired Clarify, a company specializing in system-level GPU optimization. This technology physically cuts the raw compute capacity needed to run large, complex open-source models. They also acquired EigenAI, which boasts the #1 ranked fast AI inference throughput according to independent testing by NVIDIA. Higher throughput per GPU mathematically lowers the cost per token for the end user while simultaneously improving the overall profit margin for Nebius. Furthermore, their new serverless AI platform, named Aether 3.5, allows developers to instantly run inference workloads without having to rent a massive cluster of idle GPUs. The hyperscalers often force you to rent the whole cluster regardless of your actual usage. Nebius lets you pay purely for the exact inference compute you use. That deep, system-level software optimization creates a massive cost-efficiency differentiator that generic cloud providers struggle to match.
So, what you've established is that their software and their specific acquisitions make them significantly cheaper and faster at running AI in the real world. I get that. Let's move on to Section 4, Partnerships and Power Scale. Okay, so software needs hardware. Give me an analogy of what this physical infrastructure actually looks like. Are we just talking about standard server racks sitting in a basement somewhere? And I mean, a $27 billion deal with Meta. How does a company like Nebius land the biggest social media company on Earth?
To your first point, you absolutely cannot think of these as standard server rooms. Think of them as heavy industrial power plants. You cannot run these massive NVIDIA GPU clusters in a standard commercial building. The power draw would literally melt the wiring and completely overload the local municipal grid. You need highly specialized liquid cooling, heavily reinforced flooring, and direct access to gigawatts of raw electricity. Nebius's ability to actually secure this physical power and build these specific heavy-duty facilities is their ultimate physical moat. And that brings us directly to the Meta deal. Meta needs an unbelievable amount of compute power to run their open-source llama models globally. Nebius stepped in with a uniquely structured 5-year agreement. If you look at the filings, it's a $12 billion guaranteed purchase of compute capacity starting in 2027, plus a $15 billion flexible contract that allows Nebius to sell that capacity either to Meta or to other clients at market rates. This drastically de-risks Nebius's revenue pipeline for the rest of the decade. Furthermore, NVIDIA themselves invested $2 billion directly into Nebius. When the company manufacturing the chips invests heavily in the company deploying the chips, it signals a deep structural partnership designed to ensure Nebius maintains first inline access to the absolute newest GPU technology.
Okay, so they have the cash, they have the software optimization, and they have the biggest clients in the entire world. But where are they actually building these massive AI power plants?
According to their strategic roadmap, they are executing a highly aggressive global land grab for power. They recently raised their 2026 contracted power guidance to over 4 gigawatts. To put that massive number in perspective, 1 single gigawatt is enough to power roughly 750,000 standard residential homes. They just announced a massive fully owned 1.2 gigawatt AI factory in Pennsylvania. On top of that, they are investing £1.7 billion into 3 new sites in the UK, aiming to make the United Kingdom their core European hub. This is highly strategic based on the data. By geographically diversifying across the US and Europe, they are physically insulating themselves from regional power grid failures. More importantly, they are navigating complex international data sovereignty laws, which legally require European user data to be processed strictly on European soil. They are building the capacity exactly where the regulators demand it be.
So what you just said basically means they are locking down the actual physical electricity around the world before their competitors can legally or physically get to it. That is a serious game plan. All right, let's hit Section 5, 3 future stock scenarios.
We've seen the good, the bad, and the accounting tricks. This is what everyone watching wants to know right now. Based purely on the data, the moat, and the massive risks we just discussed, walk me through the survival scenarios. What is the base case, the most likely future based on the data we have today? We have to evaluate this entirely rationally, as the market is currently pricing in a lot of perfection. I have modeled out 3 distinct scenarios based strictly on current execution metrics, market demand for inference, and the looming threat of hyperscaler competition. The base case assumes that NVIDIA successfully hits their target of over 4 gigawatts of power and executes on the guaranteed $12 billion portion of the Meta deal. In this scenario, The data suggests they will see continued hypergrowth in revenue, but we will likely see their profit margins begin to thin out. As open-source AI models become more prevalent, raw compute power slowly becomes commoditized. They will still grow significantly, but they will face intense, sustained pricing pressure from AWS and Azure. This means their multiple, the premium investors are willing to pay for the stock, will likely compress closer to sector norms. It remains a solid growth story, but the days of 400% stock returns in a single calendar year would be mathematically behind them.
Okay, I completely understand the middle ground. Now give me the extremes. What happens if everything goes perfectly, and what is the absolute nightmare scenario?
The bull case is triggered if they successfully hit their maximum forward guidance of $9 billion in annualized run rate revenue by the end of 2026. This scenario becomes reality if their Clarify and Eigen AI acquisitions create such a massive mathematically proven cost advantage in the inference market that developers simply cannot afford to use Amazon or Microsoft's less efficient systems. Furthermore, if the structural NVIDIA partnership grants them exclusive early access to next-generation chips, they could command premium pricing across the board, drastically expanding their margins and fundamentally justifying further stock price expansion. The bear case, however, is a scenario where the systemic risks actually materialize. The primary trigger here would be a macro-level slowdown in enterprise AI spending. If Fortune 500 companies decide that deploying AI isn't yielding the expected financial returns, the global demand for inference compute drops. Nebius is locked into massive, multi-billion-dollar capital expenditures for these physical factories. If their utilization rates fall, their heavy debt and capex burden could severely crush their cash flow, leading to rapid margin compression and a drastic re-rating of the stock downward.
So it all hinges on whether the world actually keeps using AI at this breakneck pace, and if Nebius can keep their specialized costs significantly lower than Amazon's brute force. All right, let's talk about a very specific number we've calculated here, $238.86. What is the real significance of that figure to an investor?
According to financial modeling derived from quantitative tools and current market narratives, that $238.86 figure represents a calculated fair value estimate based strictly on their projected future cash flows. Given the stock's recent trading levels, this specific model suggests that, despite the massive run-up we have discussed today, the stock might still be slightly undervalued, roughly 4.6% undervalued to be precise. However, it is absolutely paramount to understand that this valuation explicitly assumes that Nebius can survive the intense sector competition and execute flawlessly on these massive power center buildouts without blowing out their capital expenditure budgets.
And that is the multi-billion-dollar question. Benjamin Graham famously said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Right now, the market is voting heavily for Nebius, seduced by 800% growth rates and massive meta contracts. But in the long run, the sheer weight of their capital expenditures and the looming shadow of Amazon and Microsoft will absolutely determine their true value. Is Nebius the ultimate AI infrastructure play, or is years of future growth already priced into the stock today? That is what you have to decide based on the data we've laid out. Thank you for watching today's Explainer. Your subscriptions, likes, and supportive comments are huge encouragement to us as we build this Explainer series. Let us know down in the comments, are you a bull or a bear on Nebius? See you next time.